Look at any big company's income statement and you'll see one number for revenue and one number for profit. But what if that one company is actually three completely different businesses in a trench coat? Say, a chain of coffee shops, a wholesale coffee roastery, and a training academy? As an investor, wouldn't you want to know how each piece is actually doing? That's exactly what segment reporting is for. Today we are going behind the Café Group's consolidated numbers to answer a question every investor asks. What's actually driving this business? One consolidated income statement can hide three completely different businesses, all folded into a single revenue line and a single profit line. This is segment reporting explained, a vendor-neutral look at how IFRS 8 and its US GAAP counterpart, ASC 280, force a business to show investors what's really going on inside that one number. Behind that one consolidated number, the Café Group is really three businesses. First, Café Bloom and Café Nova, the retail coffee shops customers walk into every day. Second, Brizo Roast, the wholesale roastery that buys green beans, roasts them, and sells bags of coffee to other cafes and shops. A completely different customer base and a completely different process. Third, the Academy, a small training arm that teaches other aspiring cafe owners how to run their own shop, for a course fee. Three different products, three different customers, three different risk profiles. And yet on the face of the consolidated statements, it's just one revenue figure and one profit figure. As an investor, wouldn't you want to see inside that? The accounting standards don't just let a company draw the lines however it likes. A part of the business only counts as an operating segment if it meets three tests. 1. It engages in business activities that earn revenue and incur expenses, including activity with other parts of the same group. 2. Its results are regularly reviewed by the person, or team, who makes the big resource allocation decisions, the Chief Operating Decision Maker, or CODM. 3. Separate financial information is actually available for it. The CODM isn't necessarily one person with that exact job title. For the Café Group, it's the founder and her small management committee, sitting down every month with three separate performance packs, one for retail cafes, one for Brizo Roast, one for the Academy. Here's the core idea both IFRS 8 and ASC 280 share, and it's why we call this a management approach. Segments follow how the business is actually run internally, not some standard, external template imposed from outside. If the founder's monthly pack is organized as retail cafes, Brizo Roast, and Academy, those are the group's operating segments. Not coffee versus training in the abstract, but exactly how she manages it. Not every operating segment has to get its own line in the financial statements, only the ones that are big enough. A segment becomes reportable if it clears any one of three 10% thresholds. Test 1. Revenue. Its revenue, external sales plus sales to other segments in the group, is 10% or more of the combined revenue of all operating segments. Test 2. Profit or loss. The absolute size of its reported profit or loss is 10% or more of the greater of combined profit of all the profit-making segments, or combined loss of all the loss-making segments. Test 3. Assets. Its assets are 10% or more of the combined assets of all operating segments. Let's run the Café Group's actual numbers. Retail cafes, 2,400 in external revenue, 480 in profit, 1,800 in assets. Brizo Roast, 1,100 revenue, 220 profit, 900 in assets. The Academy, 300 revenue, a small 20-unit loss, 150 in assets. All figures in SGD thousands. Total combined revenue is 3,800, so the 10% mark is 380. Retail cafes and Brizo Roast both clear it easily on every test. The Academy, on its own, doesn't clear any of the three thresholds. Its revenue, its loss, and its assets are all below 10%. So does the Academy just disappear from the notes? Not so fast. There's a backstop. The segments a company does report must together cover at least 75% of total external revenue. If they don't, more segments have to be added, even ones that failed the 10% tests. In the Café Group's case, retail cafes and Brizo Roast together already make up 92% of total external revenue, well past the 75% bar. So there's no requirement to force the Academy in as its own reportable segment. It can sit inside an all other segments reconciling line instead. There's one more option before folding a small segment away. Two operating segments can sometimes be combined into one reportable segment, but only if they have similar economic characteristics, and they are like across a checklist. Similar products or services, similar production or delivery process, similar type of customer, similar distribution method, and similar regulatory environment. Notice retail cafes and BrizoRoast could never be aggregated with each other. Different customers, different processes, different economics. Walk-in coffee drinkers versus wholesale bean buyers. Aggregation is for genuinely similar operations, not for convenience. Here's the common mistake to watch for. Aggregating segments isn't meant to be a way to bury a struggling business inside a healthy one. If a small loss-making unit gets folded into a strong segment purely to hide its results from investors, that defeats the entire purpose of the standard. So how do the two big rulebooks compare? IFRS 8, used internationally, and ASC 280, the US GAAP standard, actually share the same backbone. Both were built on the same management approach idea, and both use the same 10% and 75% tests we just walked through. The differences are in the finer print. ASC 280 is more prescriptive about which specific line items, like interest income, interest expense, depreciation, and income tax, must be disclosed for each segment if they are part of what the CODM reviews. And a recent US update added a significant expense principle, requiring disclosure of significant expense categories the CODM regularly sees, plus segment disclosures even for a single segment company, and now at interim periods too, not just annually. Once you know your reportable segments, both standards ask for a similar package of disclosures. First, general information. What factors were used to identify the segments, and what products or services each one provides. Second, a measure of profit or loss for each segment, using whatever measure the CODM actually looks at internally, plus an explanation of how that measure is calculated, since it doesn't have to match statutory profit exactly. Third, segment assets, and segment liabilities too if the CODM regularly reviews those. Fourth, and this one trips people up, reconciliations. Total segment revenue must reconcile to consolidated revenue, total segment profit to consolidated profit, total segment assets and liabilities to the consolidated statement of financial position, with any differences explained. Fifth, entity-wide disclosures that apply even to a business with just one reportable segment. Revenue split by major product or service line, revenue and non-current assets split by home country versus the rest of the world. And, this is easy to miss, if any single external customer provides 10% or more of total revenue, that has to be flagged, along with which segment or segments it relates to. Let's put it together the way the café-group's finance team actually would, building the segment note line by line. The note shows retail cafes and BrizoRoast as the two reportable segments, with the Academy's smaller numbers folded into an all other segments line, and then a reconciliation column bringing everything back to the consolidated total, in SGD thousands. And here's the entity-wide disclosure in action. Suppose a hotel chain buys 400 worth of beans from BrizoRoast in the year. That's a little over 10% of the group's total revenue from a single external customer, so the note must flag it, and say which segment it relates to. Before we wrap up, for mistakes to watch for in practice, using a different profit measure in the segment note than the CODM actually reviews, forgetting the reconciliation to consolidated totals, skipping the major customer disclosure, and aggregating segments that don't genuinely meet the similarity criteria. So that's segment reporting. Find the real operating segments the way management actually sees them, test them against the 10% thresholds, check the 75% coverage backstop, only aggregate when it's genuinely justified, and disclose enough, including the reconciliations and the major customer rule, that an investor can finally see inside that one big number. Thanks for watching. If this made segment reporting click for you, that's exactly the goal. One coffee shop, one roastery, and one academy at a time. Want more lessons like this one, built the same way, one cafe story at a time? Head over to the BrizoConsol Academy page on Udemy, linked below, for the full library of consolidation and financial reporting courses.